Hello and welcome to the Daily Finance Wrap, your daily dose of personal finance updates covering investments, insurance, loans, real estate, and everything else to do with your money. We would love to keep the show interactive, so please feel free to write in with your questions and queries, and we'd be more than happy to take that up with our expert advisors. I'm Samina Nalwala, and it's time for the top headlines this Diwali evening. Swiggy has received bids from some big marquee investors for its IPO. Norway's sovereign wealth fund, Norges and Fidelity, has submitted bids exceeding $15 billion, which is 25 times the $605 million set aside for such investors, according to sources. Swiggy is all set to hit the primary markets with its $1.35 billion IPO next week. Following a recent drop in stock market prices, Swiggy has lowered its estimated valuation for the IPO to $11.3 billion, 25% lower than its estimated $15 billion. And now, starting tomorrow, mutual funds will be subject to SEBI's prohibition of insider trading regulations. Under these new rules, senior employees at fund houses will not be allowed to sell their mutual fund holdings if they have confidential information about potential issues within the firm or any of its schemes. This measure aims to tackle concerns about fund managers making poor decisions that lead to significant drop in net asset values, while some senior officials sell their units in advance. SEBI has expanded the insider trading regulations to include mutual fund officials, board members, sponsors, trustees, auditors, legal advisors, bankers, and consultants. The new regulations are designed to prevent insider trading and safeguard investor interest. And the RBI has come up with new regulations for escrow accounts. Previously, NBFC P2P lending platforms were required to maintain two escrow accounts, one for funds from lenders awaiting disbursal and another for collection from borrowers, without a specific timeline for transfer of funds. Under the new regulations from the central bank effective November, the two escrow account structure remains, but with stricter guidelines. Funds in these accounts must now be transferred within 1 day of the transaction date. The funds in the lender's escrow account can only be dispersed to borrowers, while the funds in the borrower's escrow account can only be used for repayments to lenders. This ensures better segregation of funds and more timely processing of transactions. But guess what? It is the Diwali evening. Happy Diwali to all our viewers. Happy Diwali to Vivek. Good evening, Vivek. Thank you very much for taking the time out to join us today. Today's discussion on the show is going to be for all our viewers who want to understand and learn how one should create and maintain a mutual fund portfolio for a 5 year time horizon. Joining me to discuss this is Vivek Rege, founder and CEO of VR Wealth Advisors. Hi, Vivek. Thank you for joining us today on the show. Vivek, very basic first up question. What are, in your opinion, the fundamental steps an investor needs to follow while building a 5 year portfolio in the current Indian market context?
Thanks, Samina. Happy Diwali to all the viewers. A great question because it's a very, very fundamental and a question I think very important for the investors to kind of understand how to look at building a portfolio. So primarily, there are three pillars one should always remember. The first pillar is essentially the purpose. The second is the period, and the third is the profile. So let me explain you very quickly what it means. So when we talk about purpose, it essentially means your goal. Why are you investing? What is the goal? Why do you require the money after a 5 year period or any period which you have kept in mind? So the purpose is very, very important. Once the purpose is clear, then of course, as I said, you go on the period, which is essentially known as the tenure in the investment world. So once the tenure is fixed, you generally know the purpose and the tenure. And the third thing which connects all of this is essentially your profile. By profile, I mean is the risk profile, is the essentially the risk tolerance which any investor can bear. So I look at it from this point. It's nothing but your financial DNA. It is something which you are wired inside, something which we cannot see. There is a technique through which one kind of understands the tolerance of an investor. There are various tools also available online, but it's very important because when you connect these three pillars together, you create a very solid foundation for building something as a portfolio, what we call as, and then nurture it over a period of time.
Hmm. Vivek, I know this is ideally and best done with the help of an expert like yourself because you go through the process, walk through the process of discovering these objectives of investors, understanding their risk taking ability, and more importantly, their objectives. But assuming somebody chooses to do this DIY, right? So they're young, they want to build a portfolio from a 5-year time horizon. How should they be looking at this between balancing risk and return, especially given that the time horizon is 5 years? It's not 25 years, and neither is it 1 to 2 years.
So, great question. I think if somebody is a DIY investor, my simple suggestion will be that, as I said earlier, is that keep your fundamentals intact, which means the purpose, the period, which is now 5 years, which is now clearly defined, and your profile. Okay. So when you take all these three elements together, you basically try to look at something which will satisfy the objective. The objective is 5 years, which is not very long enough also. It is maybe a medium term kind of a tenure we are looking at. We have to understand that in this 5 year period, 1 year, 6 months to 1 year will go for you to settle the portfolio, means to start creating a portfolio. Because generally, you cannot, it's not a start and a stop button where you can just create a portfolio like this. It needs a little glide path for it to kind of move. So, let's say about 6 months to 1 year, it kind of completes its cycle of creating a portfolio. Then, as you near the 5 year period, you need a 1 year cycle to glide back towards the liquidity because you may not want the portfolio to really be at a point where there can be uh, corrections and your portfolio gets affected. So typically, when you minus these two periods, which is the building period and the unbuilding period of 1 year, you are left with 3 years in between, which is also not a very long period, to be very honest.
Hmm.
Therefore, when you look at something, please keep in mind it will take a year for you to take off from the point zero. It will take you 1 year to land to point zero, and only 3 years in between in which you can say the portfolio is fairly stable and you are invested in the portfolio. So keeping all the constraints in mind, you have to then look at what are the suitable, options which are available, keeping in mind your risk profile because that will be very important. And without compromising that, what are the products in which you can invest, which can give you this glide path to move up and come down in a very systematic manner. Okay, this is not a rocket science, but there is some principle in which you will have to kind of look into building the portfolio and unbuilding the same
Hmm.
at, at a
I
period of
think
time.
very, very valid. And of course, while my next question is going to be a lot more subjective, because I do understand building a financial portfolio for an individual cannot be a cookie cutter approach, right? Because people are at a different age, a different
Yeah.
cycle in life, different objectives. But let's attempt to try and do as much as we can. So if you've got a individual with the average risk appetite, middle age, so I'm not going to say the individual is very young or very old, in the 25, 30-year-old bracket, uh, what is the ideal asset allocation he or she can look at from a 5 year time horizon? So we'll talk about products, but let's get at the portfolio level: equity, debt, InvITs, REIT. How do you split the portfolio?
Uh, so let's again start with the fundamental position is that we are looking from a 5 year period, and I think that remains intact. Now,
Constant.
that remains constant. Now, what do you do in that, right? Very important that you have to cut all the noise. It's very important to be very sharply focused on what you are doing too much of noise, too many instruments, too many vehicles to take you to some point is only going to create confusion. So essentially, you will have to figure out a fairly simple way which can pretty much do the same or similar, outcomes uh, with a very moderate kind of a risk, because you are again talking about a moderate investor profile, somebody who is in the age of 30 35 age bracket. So
I'm
let's
so glad you call that middle life. That's a good thing.
so uh, so I think what one should look at is that because it is moderate, let's keep a cap of 50% on the equity end, because it is moderate, right? And if you find yourself having uh, a slightly conservative kind of a profile, maybe you can glide towards 35% of equity, right? So anywhere between 35 to 50% equity on an asset allocation basis should be good enough. Generally you should end up doing a good job over a period of time. Now within the instruments, the simplest thing to pick up is a mutual fund which can help you to reach there, because the minute you start figuring out securities, direct securities to put in, you need a lot of effort, you need a lot of study to be done. And please understand, there is a very thin line between investing and speculating, right? And therefore, if you study, if you have time to study, if you can give justice, you understand what you are doing, then it is investing. If you minus all of that, you are speculating. Okay. So I'm saying that if you have a moderate understanding also about this entire world of investing, it is better not to dabble directly into securities market. Better to kind of get into a mutual fund and then figure out what would be suitable for a profile like yours, and with the horizon what you have specified, which is 5 years, you will get ample number of categories in which you can look at investing, something like that. So my advice will be, keep it simple, cut
Hmm.
all the noise, and be
You're
very
right.
sharp.
Right. I think that's the one thing we need to very clearly tell our viewers, right? If you don't understand it, don't do it. I think that's a very simple, basic advice that you need to practice. But once, Vivek, you get the asset allocation right. So you do 50% equity, say 50% debt. Now comes step two, which is product selection. And now you've got to plug in products across equity, debt, and also in some cases a balanced fund, which is a little bit of a overlap between equity and debt. Do you advise investing in a balanced or a hybrid or a dynamic fund, because that does asset allocation on your behalf? Or do you think an individual needs to do asset allocation at their portfolio level and then get down to step two of simply plugging in equity and debt mutual funds?
So see, the answer is not very simple, but let me put it this way: is that you should have a lot of liking in doing something and creating, different baskets like equity differently and debt differently, and you should really understand those components. I can tell you with my experience that people who understand equities may not understand debt so well. Debt is a very complicated product in itself, and therefore understanding both of these together, you really need to have a very good technical understanding about what you're trying to do. uh, Again, to keep it simple, and because there are viewers who are may not have technical expertise beyond a point, it is very good suggestion to actually look at a balanced fund. A balanced fund will do exactly the job you want to do based on your asset allocation. So for instance, you need a 50% equity allocation. Let's take that as a use case, in which case what will happen is that you will have a product or a category in which you will be able to fulfill that particular objective. Okay, let the fund manager do the job of picking equity and picking debt, and also change based on the cycles between equity and debt. Because please understand that the minute you bring emotions in between investment, it generally doesn't do well, and it's not anyway very long time, because 5 year period is not a very long time to even experiment something like this. So it is good to have a product which, or sit in a vehicle which can take you to a destination much smoother manner without too much of hiccups. So
Hmm.
typically a balance fund would exactly do that for you
Right.
without getting into the nitty gritties of picking up the securities.
Right. Right, Vivek, assuming that, so balance fund, of course, is one sort of offering that could play the role of asset allocation. But if one has the ability and they are, using and working with an advisor, let's also help them ask the right questions, right? So if you are building a 5-year time horizon mutual fund portfolio for a client of yours, what are the key attributes or factors you would consider or you would advise somebody to consider while plugging in or identifying the funds, because the universe of funds is only getting larger every day?
Yeah, that's very true. So I think to answer this question, it's very important to understand the life phase and the life stage the client is into typically. And with a 5-year horizon, you also need to understand the taxability piece for the client, because there might be clients who might come in tax brackets which are lower, and there are clients who may come in tax brackets which are like marginal tax brackets where the surcharge is charged. So you have to kind of understand that piece very well, because taxation will definitely play a very important role in your decisions. The minute you try to separate it, there will be different implications, because the taxation works very differently for an equity oriented fund and a debt oriented fund now with the new tax laws. So therefore, if somebody wants to do a portfolio and has an advisor, typically uh, to work with, essentially, I think very important is that if you are looking at a equity and a debt separately, please make sure that you are very clear and you ask the right questions to the advisor in terms of the taxability, right? Because now with debt funds, even if you are holding for any umpteen number of years, the taxation will still be considered as a short-term capital gain. So it's very important that you ask the right questions so that you don't have a disappointment later when you are liquidating a portfolio. Because please understand, after 5 years, you have to liquidate the portfolio.
Hmm.
And by liquidating, you might end up paying taxes more than what, and it might create a suboptimal outcome as well.
Right.
Uh,
Right. Please continue.
yeah, so people sometimes in this pursuit sometimes get the asset allocation wrong. Okay, they do more on equity and less on debt for something which is 5 year, having a moderate profile. So they are violating all the rules possible, because taxes is not working in the favor. And therefore, when you look at something like a hybrid kind of a fund, it gives you the ability to at least make sure that you don't have adverse shocks on the tax element, especially when you are unwinding the portfolio.
Right. Uh, Vivek, so now we've got the asset allocation and we've got the product part of it, at least largely, right? In your opinion, in the current setup that we are in, and there are lots of people who believe that if you buy lots of mutual funds, you will create wealth and you'll beat the market. But we do know that you can't own the market and beat the market, right? So, what, in your opinion, is the right number of funds one should have across equity and debt in a 5-year portfolio?
I think at an aggregate level, one should not look at more than 5 funds. I think 5 funds, maximum 5 funds should do majority of your job. So whichever way you look at it, it will give you different flavors also, and you will be able to achieve the kind of the same objective. So anything more than 5 will actually create a suboptimal kind of because there will be too many funds in the portfolio just for a very shorter period of time. So do your study, focus properly, ask the right questions, make sure that your the purpose, the period, and the profile is not violated, and make sure that the funds what you choose uh, don't have overlaps, but at the same time it gives you different flavors in a way which can complement each other very well in different market cycles. If you get a one or two different market cycles in this 5 year period, you are able to still make a decent landing at the end of 5 years. Maybe I will look at that number of five and just maintain it there.
Right. Uh, Vivek, right. So once we get that, five is a good sort of number of portfolios one can have because it's also easy to manage in that case, right? Now, another very pertinent question, and I'm not asking you just because the markets are volatile right now, but what, in your opinion, is the right way to do this? So, if you have significant money that you currently have, would you advise investors to make a lump sum investment, or would you ask them to stagger it over a period of time? And while the staggering across equities is taking place, would it be a good idea to hold that money in debt and then do a systematic transfer to equity on a regular, in a regular disciplined manner?
See, as I said in the beginning of the show, that there is always a glide path. So when you take off from point 0 to point 10, you have a glide path. uh, and it is good to have a glide path because you give time for the portfolio to get built up. You might get into different market cycles within this. Even a 1 year period, you might have different flavors in the market as you kind of move towards that. Very good to stagger it. Okay. uh, and settle the portfolio maybe 6 7 months down the line, so you have a good 6 7 months to kind of at least move and settle the portfolio. If you have a large sum of money to deploy, I would definitely at this juncture definitely not advise anything which has to be done in a knee jerk, saying that hey, let me invest right away. I don't think that will work. Go slow, go steady, have a glide path, move steadily and increase the allocation over a period of time. And what do you do in between, right? You park in a liquid fund, and then from a liquid fund, you move it through a simple STP route, which works on a weekly basis. So let's say if it is a 7 month period, you get approximately 28 weeks broadly, 28 to 30 weeks, to kind of glide it upwards, which is a good time frame, kind of to you know aver- to average it out.
Right. Vivek, I know this is may not be an ideal sort of question, but I'm still going to attempt it because a lot of people would want to know, right? Do you think there are any specific sectors or themes that one could invest in for the next 5 years to create or build a portfolio that will outperform the Nifty? Uh, I mean, of course, I'm going to leave that open because you can share your views whether a thematic fund is an idea or a good sort of investment product, or of course, you can even tell us that you think a flexi cap may be a better way to do this.
See, again, starting point was that you are a moderate investor with a 5 year horizon. I think keep that intact. Keeping that intact, we have to make sure that you don't end up second guessing the market. Uh, Keep it simple. A diversified equity fund will do a decent job. And when I'm saying diversified equity funds, it also means diversified equity funds and debt separately, or it could also mean a balanced, a kind of a hybrid fund. Why I'm saying that is essentially because normally when you are looking at a sector fund, you have a very deep understanding about a sector, and it is most of the professional fund managers also try not to go that way beyond a point unless it's a kind of a sector fund. If they find the sector to be attractive, of course, a fund manager in a diversified fund will always take exposure into something which is, he or she finds it attractive to invest as a fund manager. So I think if you leave that decision to the fund manager, it is better rather than getting into a very narrow zone and saying that hey, I will look at a pharma sector, oh, I will look into a let's say an IT sector, for instance, or a banking and financial, for instance. So you are trying to narrow down the universe of the market and look at a particular sector and get into it with the hope that this will really outperform the market. which is the broader market. In my view, I think one should not look at doing something like this unless you have a very deep understanding about that sector, or also a theme, for instance, because a lot of thematic funds have been launched recently, and it's a flavor of the season. So please understand that the flavors come and go. And if the fund manager in a diversified fund can take that same call based on the attractiveness, he or she will definitely take it. Because by design, a fund manager always want to outperform the market if it's an active fund. So therefore, by design, the fund manager will try to do something which is the right decision to beat the market in a certain time frame. So I would not go that path or route where one chooses a sector fund or a thematic fund to outperform the market. I don't think I am of that school of thought.
Vivek, you alluded to this in the first part of our conversation, but just to recap this for our viewers, how can investors optimize tax efficiency when choosing mutual funds, especially for equity linked saving schemes or long term debt funds? And also, in terms of exit, what are the tax implications one needs to keep in mind?
Yeah, so the tax laws have recently undergone its change. And so, what it essentially means now is that if you're investing into a debt fund, you typically end up paying the same tax as what you pay on a fixed deposit interest. Typically, yeah. So, uh, yeah, there are few advantages. For instance, if you have a short-term loss to set off against a short-term gain, all those tax optimization and tax harvesting strategies can be availed, provided you have something on your books. If you don't have something on your books, it might end up to have a very suboptimal outcome when you are paying higher taxes on something which, without knowing, you have kind of invested. uh, what does a hybrid fund try to do? Okay, a hybrid fund which is having an equity orientation, and equity orientation may not necessarily mean net equity. It may also mean net equity and arbitrage, for instance. So if you look at a equity orientation of 65% and above, okay, your long term capital gain after 1 year is going to be 12.5%. Now that is very important, because if you keep that in mind, then with this period of kind of 5 years, you have a good time for you to build the portfolio, settle it down for 3 years, and kind of unwind it over a period of time. You might not be hurt because you have anyway crossed that 1 year period, so therefore you are eligible for the long term capital gain. And therefore it is very important to keep that in mind. Without that in mind, and if you dabble into different asset classes separately, you might end up doing a suboptimal outcome, keeping this 5 year period in mind.
Right. Vivek, I'd love to talk to you longer because there are so many more aspects, right? One thing is creating the portfolio. Second is, of course, managing it. And that cannot be an easy job either. But maybe we'll do that in our next conversation. We are out of time, so I'm quickly going to go over and take a viewer query that's come in. And this is written, Ro writes to us. Ro, happy Diwali to begin with. Ro asks Vivek, what's the best time frame to have for a beginner investor? Is 5 years horizon good for everyone and anyone?
So this is a very interesting question. So see, what happens is that I'm of the viewpoint is that your long term happens when you look at short term and medium term, over a period of time. So these are baby steps. uh, when you look at your life, you may have long term or ultra long term goals today, or you could also have ultra short term goals today at the same time. Okay, so therefore it is not very simple, and hence it is good to start your investment journey saying that, hey, look, I let me start investing, which means first of all you need to save. Once you save, then you will start investing. The minute you start investing, you look at a period which is reasonably good, where you have a line of sight, right, in terms of saying that, okay, let me look at a 3 year period or a 5 year period, and let me then make up my mind what I have to do in future. Because currently, when you are starting with, you may not directly look at a 30-year period, because you may not be able to visualize what is going to happen over the many years with your own life as well, your own occupation, uh, the place where you are going to live and earn and kind of save and invest. And it's a VUCA world. It will keep changing, and you will also need to kind of keep changing. Therefore, I think it is good to start the journey and look at periods which are maybe 5 year period, which is a good period to look at. As you're nearing 5 year period, you will have a sense about whether you want to extend it further. Are you going to require the money for some goal which is kind of getting much more clearer than before you started, right? So as a beginner, I'm saying that you will go through different life phases and life stages, and you might suddenly find yourself saying that, hey, this goal has come much earlier than what I thought, and therefore it is good to have agility and flexibility. uh, Keep a 5 year horizon in mind. If you don't require it, you know what is going to be in the next 5 years, and keep reviewing that and extending that. So I think that will be my advice to you.
Right. Rohan, hopefully we've tried, or Vivek has tried to answer your question. But with that, we're completely out of time. It is the auspicious time for all the pujas. Vivek, happy Diwali to you and
Thank you.
yours. We'll hopefully see you soon, and may this somewhat bring and be a prosperous one for you. Thank you for watching.
Thank you very much. Bye
Thank
bye.
you. Bye.